to VCTV. I'm Kyle Ellicott, your host, and we have an exciting episode yet again today. We talk daily here on VCTV about what's happening in the world on different markets, different industries, different technologies, and where they are taking place around the world. Yesterday, we talked a lot about supply chains and transportation, what was happening in transportation around the world, and technologies that were being applied to the transportation and mobility industries that were helping to push it forward. We even talked a little bit about the reality of flying autonomous vehicles, which leads us into today's discussion, where we're going to be talking about the hospitality and the travel industry, two industries that have been dramatically impacted over the last 6 months and may be further impacted for the next 6 to 12. But we brought together some of the biggest experts and investors from around the world to share with us what's happening, where things are going, and how technology and investment will play a role in these industries' futures so you can be prepared to find the opportunities, build for success in hospitality and travel. Now, as we do with every episode, welcome to the show. Feel free, as we are live, to enter any questions or comments in the box. I'll do my best to ask them in real time. If not, we're all available online just about 24/7, so feel free to reach out to us at any time. And also, thank you hugely to Elena and to the entire LA Token team for bringing VCTV to you from around the world and bringing all of us together. Now, without further ado, let's go ahead and start introducing each and every one of our speakers for today's topic. Peter, I want to welcome you to the show. If you could, just a quick introduction about yourself and a little background on how you got into the space.
Thanks so much, Kyle. So my name is Peter Blaut. I'm from the executive director of the Weimer Family Office. I'm based in London. Our family office is based in London and Denmark. We focus on funding opportunities in the real estate space across residential, office, and hospitality, anywhere from 150 million to several billion. Since the post-COVID crisis, March 31st, I've probably put about $3.5 billion to work across the real estate space globally, as well as in the hospitality space. So really look forward to a productive panel today and how we could all be helpful.
Wow, looking forward to hearing where you deployed that capital as well. This is exciting. We have another investor that we're going to welcome back to the show, who I've had the pleasure of speaking a few times with, who I know has made some investments during this time as well in this space. Brian, welcome back to the show. If you can, for those who may not know you in the audience, a little background on yourself and a little introduction, and you're on mute.
Hi, well, good afternoon, good morning, everyone. It's Brian Hallweil here. I'm speaking to you from Sag Harbor, New York. I work in the venture space, primarily across the food chain in food and agriculture, from CPG and grocery to hospitality and all the way back to the farm with software, hardware, and other technology solutions. I work with a venture fund in New York City called Almanac Insights. We invest across the supply chain, have some investments we're going to be announcing shortly. And obviously a lot of deals have changed over the last few months, and we've seen some really fascinating trends in grocery, but really all across the food chain in the last few months. So I'm also excited to talk more. And I should also say, I also work with an organic farmland fund named Belltown Farms, which operates large-scale organic farms in the United States.
Welcome back. We did an outstanding conversation together about what's happening in the food tech space. So if you haven't checked it out, go to the VCTV archives. Shameless plug for Brian. It's definitely worth your hour's time after today's episode, of course. Ron, welcome to the show. If you can, a little background, a little introduction on yourself. Oh, Rand, we can't hear you. You might be on mute. Looks like you're on mute both on your phone and on the computer. No stress. Robert, welcome to the show. We'll come back to you, Rand, in just a minute. Robert, welcome to the show. A little intro and a little background on yourself.
Sure. So I work for Northwind with Ron. Ron started the firm in 2008. It's a real estate private equity firm based in Manhattan, investing across multiple asset classes, both debt and equity. Currently own a hotel in the Soho area that's on our equity platform. And we're also in the process of launching a debt fund, $220 million dedicated towards bridge financing in New York City, and then also other gateway US markets.
Wonderful. Excited to go into that a little bit further. Ron, welcome to the show. If you can, an introduction, a little background on yourself. You're still on mute. Looks like we may be having some technical difficulties there. Yeah, we've got you on mute. There you go. So we'll come back to you for introductions, but Robert, I think, did a good job introducing you guys. Everyone, welcome to the show. Rand, can you hear us?
Yeah, I can hear you very well.
Okay, there you go. We can now hear you. A little introduction, a little background on yourself.
So I founded Northwind Group in 2008. We invest in real estate, healthcare, hospitality, predominantly in the New York area. We have about $2 billion of assets under management right now. And as Robert mentioned, very active right now in the lending space in New York. And we've been slowly growing our footprint here as well as in the Midwest of the United States.
Very cool. Well, and let's go ahead and start there. So what is the current state of affairs around hospitality and travel? I mean, you've got $2 billion under management. You're deploying capital in these spaces, both in New York and the Midwest. What are you seeing as kind of the current state of where things are right now in hospitality and travel?
I would say that hospitality specifically in New York City is probably in the worst place it has been ever. Most of the hotels are still closed. Those that are open are showing 10 to 15% occupancy, very minimal ADR, average daily rate, sub 100, which is unprecedented for New York City. And the outlook, quite frankly, is pretty pessimistic. What we're seeing right now, a lot of hotel owners are trying to find alternative uses, doing adaptive reuse. Some are trying to turn them into dormitories with New York-based universities. We actually need bigger footprint to house their next semester students, because current dormitories do not allow for, you can't do 4 people in a room like they used to do before. So some hotels are doing that. We've been engaged with NYU and our hotel in an RFP. It's moving slow, but it's a process that will eventually probably materialize. Some are turning into as extreme as shelter and homeless shelters, and some are still housing corona patients or first responders. But it's pretty grim, to be honest. I think our personal approach, it's not going to be solved in 2020, and probably only 2021, late 2021, you'll start seeing a rebound. And a lot of owners will need to find financing solutions to carry themselves. They'll need to work out with their lenders or equity partners to be able to remain afloat. I think we're going to see a wave of defaults and foreclosures in the space.
Yeah, we heard a little bit of a similar sentiment in the past few weeks as well around this industry. But Peter, would love to hear your comments as well as kind of the current state. What are you seeing? How are you feeling about this industry and where things are shaping out?
No, that's a great question. So thanks, Kyle. Let me echo some of this previous sentiments. First of all, I think it's important to put the hospitality industry in context and the larger tourism space. The U.S. is the largest recipient in the world of actual tourism dollars. However, relative to GDP, it's very, very modest. In contrast, sitting here in Europe, Italy and Spain, the tourism sector represents upwards of 15% of their GDP. So the current COVID shutdown has absolutely decimated both of those economies. COVID has obviously decimated many economies, and if we look at GDP numbers, which will likely come out in the US over the next couple of weeks, it wouldn't be surprising to see downward GDP numbers of anywhere from 15 to 20% plus in the developed world, including the US, probably closer to 30%. So that's the magnitude of the destruction that's taken place. In terms of the hospitality space, in the next couple of weeks, most of Europe is opening up. And with that opening, the biggest challenges for the hospitality space, particularly on the hotels, is 5 challenges. Number 1 is opening. Opening to what? From 0 to 20% occupancy? Is it going to go from 20 to 40? It's clearly not going to go up to 60 to 80 anytime over the next 12 to 18 months. The second thing is social distancing. The third is cleanliness, basically, and the costs surrounding cleanliness. I was just recently shown a document from the San Francisco local council, having to clean tables every 30 minutes. The cost for that is massive, and that hits right to the bottom line. It's a fixed cost. So imagine the number of hotel beds by the number of days in a year across the industry. Even if it's a couple dollars per ADR, it's a massive hit to the hospitality space in terms of fixed costs. Then we talk about third would be pricing, and then obviously occupancy. So the hospitality space is not going to see any return to any somewhat of normalcy, probably at least for 24 months minimum. However, at the Weimer family office, I've already closed engagements and term sheets. As I mentioned, a good portion of the $3.5 billion that I've put forward, I would say about maybe a quarter or so is in hospitality around the globe. That's both in Latin America, the US, all the ways out to the UAE and Australia. We're looking for good operators, good management teams that have executed through cycles, have the liquidity to bear the brunt of this particular pandemic, and then be the ones that are standing going forward. We've been lucky that the Federal Reserve has allowed for the buying of high grade and high yield debt, which has allowed many companies to access the debt markets and prevent an otherwise significant bankruptcy situation that otherwise could have been averted. So again, not positive, cautiously optimistic. We're putting our capital where we think the survivors will be and those businesses that can execute on their plans.
Of the countries you just mentioned, or regions, I should say, where are you seeing maybe the most activity or opportunity right now?
I'm going to do it 2 ways, Kyle, because it's quite interesting. Number one, sitting here in the UK, the 3 things that are sacrosanct to the British are the following. You pay for your car, you go to the pub, and you go on your vacation, in that order, because you can live in your car. So the reality is the pubs are opening, vacations are opening, and people are looking for the cheapest places they can go. The problem is we're already seeing a surge in COVID cases already, and some cities are on the verge of shutting down. If we go always out to Australia, just last night in Melbourne, they basically closed down for the next 16 weeks because of spike in COVID cases. So people are trying to travel. It's going to be just like in the U.S. Staycation is going to be more the situation here. In terms of the opportunities are interesting. The opportunities are in the high end areas, like the Six Senses types of the world, where social distancing is the norm, and that's why people are paying well over $1,000 a night to stay in those places. So I think those continued type of hotel operators will continue to benefit. I also think the lower end accommodations that satisfy kind of the business traveler, or though most business travelers can work quite productively at home, the Courtyard Marriotts, for instance, the Ramada Inns, where close to airports, quick travel, business traveler goes and leaves, or you get the traveler that wants to stay for an extended period of time to visit their students at schools. Once schools start to open up again, I think you'll see those kind of assets benefiting. The net is dollars are both from asset managers and others like ourselves are, again, trying to find operators and managers that have the staying power and that could survive a continued low occupancy, 20 to 40% or less for the next 18 to 24 months with the higher fixed costs.
And we're going to come back to that here in just a minute. But first, I want to get Brian. What are your opinions on both on what Ron and Peter just mentioned? What are you seeing as the current state of affairs around hospitality, travel, and we'll throw tourism in there as well, as Peter brought that up? Oh, Brian, you're on mute. Yep,
Yep.
no worries.
Yeah, I mean, I think they're accurate. I think they're very smart with how they've described the situation, both, immediate term and long term. I mean, just to deep dive a little bit more in the food realm, I mean, as we all know, restaurants have been hit as hard as anyone, partly even in their new open state, in places like New York, where we've entered phase 3. So there can be, in some parts of New York City, there can be indoor dining. They're operating at 20 to 25% capacity. So the question is, how long can a business do that before running out of cash or the will to go on? The additional costs of doing business nowadays are outrageous. I'm involved with my local farmers market. Everyone in the market, vendors, shoppers, everyone has masks. There's sanitation everywhere. I mean, these are never things. There's enormous signage that we never had to budget for. So I think the one thing you're seeing, the only sort of innovation you're beginning to see, or let's say the business model that works, you see pizza shops operating, near, high capacity. Coffee shops are flexing to become small grocery stores. Obviously, grocery is very strong in cities still, but traffic in stores is down 60%. So people are making this tremendous push to online. But the restaurant of the future, it's very unclear what that will look like. A quick serve like a Shake Shack or Sweet Green in New York, volume is down in some places. They're operating at full capacity with delivery, but it's not the same sort of user because people are not at work having lunchtime work delivered to a WeWork or to another, co-working space. So it's all being pushed to the home, which was sort of the theme of our previous call. But I would second what they're saying. It's hard to see the opportunities right now.
Yeah, and on the note of business models, I mean, everyone points to 2008, right? And the fact that Airbnb, 2008, 2009, 2010, Airbnb was created and really created this whole new economy, but also boosted a level of tourism we hadn't seen before. In terms of innovation, what are you guys seeing around opportunities, whether that's virtual reality, that's artificial intelligence, that's data being applied? Where are you seeing innovation really start to be applied to these areas and maybe pushing forward some kind of unique path? So Brian, let's start back with you.
I mean, I think, if I can point to some recent news, the acquisition by Uber of Postmates and then another big merger that prompted that. Delivery is the premium. That's where all the opportunities are going to be. Everyone is talking about, there's a lot of talk about slimming down product offerings. So reducing SKUs as a restaurant, reducing SKUs as a grocer. And I will say that the notion of a simplified menu makes sense. I haven't seen obviously just in terms of streamlining, reducing labor costs, increasing margins. I still haven't seen a ton of innovation in terms of sort of automation, robotics. I think we're still way too early. But surely that would help. And I think there's a big push into robotics in a lot of other parts of the food chain, given the additional sort of burden on labor right now.
Yeah, Ron, what are you seeing as well in this area of innovation? And to Brian's point, I've heard a little bit about robotics being implemented in terms of delivery, automation, maybe on optimizing supply chains. But I mean, where else is technology playing or not playing a role in these two areas?
Before I touch on technology, I want to add one more comment that I'm seeing here in the US. It seems that it's hitting, if we talk about the hospitality industry, a bit differently, the different type of asset classes. I mean, the core urban hotels in New York and other major gateway cities are extremely hurting, but we're seeing that the destination hotels, the vacation hotels, areas in Florida, the Carolinas, are actually doing quite well. So it's one of these cycles that you really need to be careful looking at the type of assets you're looking into, and there's going to be more what we call staycations. People are going to stay in their country within the U.S., but they'll travel. I mean, myself included, and all of our colleagues and friends, they have plans. They're going to go up to New Hampshire. They're going to go down to the coast, and so travel will happen. And I think talking about technology, what I'm seeing is the ease. Those that are adapting easier online booking, clearer, those that are presenting the product in a clear manner that you know what you're going to get, are finding that they're making higher occupancy right now. Retail wise in New York, if you talk about food, is I'm seeing new operators that have always been barred from entering New York City because the cost of entry and the rent prices were just exuberant. So a lot of these, I would say, medium and small businesses that have looked into going to the city and try locations and were kept out are now starting to come in. And the challenge for them is seeing the spaces. So I see a lot of technology enabling to show spaces, lease online, do the full 360 process from viewing it all the way through actually transacting. I think that's going to be a very interesting technology that's going to get implemented, not just in hospitality and retail, but also across the board in real estate, in office and residential leasing. I think we're going to see more and more of these online marketplaces that allow you to look at spaces and transact.
Kyle, if I can jump back in, sorry,
Sure.
Ren reminded me of a point that I had planned to make. It's a fascinating point you make about regulations loosening a little bit in New York. I've heard about it in Memphis. I've heard about it in San Francisco. Memphis, which is a fairly restrictive city in terms of alcohol, because the restaurants were in such crisis, they were allowing them to sell liquor on the sidewalk, which was never allowed before. And the state liquor authority and others have not enforced it. They've basically allowed the restaurants to push in that direction. And you hear about that, obviously, in my own town. There's outdoor dining now everywhere, which was not allowed a few months ago, on side streets and parking lots, et cetera. So I think there could be some pretty fun loosening of regulations that are kind of overly bureaucratic, at least I think from the perspective of the eater. Maybe, especially where there are large open spaces, I can see restaurants pushing outside, very creative separate tables. And of course, the core city struggles with that. Even getting into a building and going up to a beautiful rooftop, beer garden above Italy is not an easy thing to do right now. So Italy. But nonetheless, I think it's a great point about how we're seeing certain businesses break in with business models that would never have been considered a few months ago.
Yeah, and I want to come back to the business model aspect, because I think even with Ron just mentioned, the idea of viewing or showcasing and transaction, there is definitely new business models that have to be being introduced throughout that process. I mean, when you apply virtual reality to go view a property, there's going to have to be a service attached to that. There's going to have to be some kind of monetary exchange in some way, shape, or form. So we'll come back to that. But Peter, what else are you seeing on the innovation and technology side, as well as we're kind of continuing this discussion?
Yeah, so Kyle, where I'm focused mostly is obviously putting capital to work. Where I'm seeing the most innovation is in the ability of sharing in real time data and data presentations. Because of the concept of Zoom, Microsoft Teams, Google, etc., we're able to do roadshows. Well, not roadshows. We're able to see roadshows of developers and other investors right on the screen that they could point to, mark up, as if we're all sitting in a room together. And that's invaluable, particularly when we need to look at getting engagements and term sheets signed and stuff. And then just basically getting to know each other. We're able to share in real time with a group of people rather than a presentation just being sent around. We could see that on Zoom. We've also seen developers being very creative, particularly hospitality companies, as well on the developing side, and having their architects show their CAD CAM stuff and developments on the screen on the Zoom chat, so we can really dig down deep and do the analysis work while we're all sitting at home, which goes to one of my significant fundamental tenets. We're spending a significant amount of time and effort in the build to rent space, co-working, co-living, repositioning retail assets, companies that are going bankrupt, look like they don't have the liquidity. The ability to just say retail is dead is absolutely wrong. It is dead. Obviously, Amazon's taking it, but the ability to reposition these buildings into either hospitality assets or rental assets or a combination thereof is something that is being looked at by family offices and asset managers like ourselves to try to figure out what is an innovative way to deal with these dinosaur type of assets, such as the high street retailers, so repositioning them for something else. And it's amazing how we're able to transform pretty much a retailer into, obviously with local council approval and regulations, to some co-work, co-living type of environment where people can co-work at home with other co-workers with obviously social distancing. But that's the biggest thing that I think is going to transform the real estate industry over the next several years, is this co-work, co-living, repositioning of dinosaur type of assets. And that includes state office buildings as well.
So let me push on that for a minute, because I have a very different view, having been in both spaces of co-working and then also renting of co-working and running these spaces. Do you really think that in the next, or do you think that in the next 12 to 18 and 24 months that co-working is going to be a desired thing, that people are going to want to go to co-working spaces to cohabitate and co-work together, as potentially work life is shifting a little bit in some way? And we've seen the not so positive with WeWork's model not go the right way. So I bring this up not to point, but just to go further on that subject. I mean, right now, here in the Bay Area, people are not necessarily going into those co-working spaces nearly as fast as they were. Most companies have left or have set aside time to go back later next year. But those offices are very different and will be very different. So do you think that this is going to be a trend continuing, or is this something just short-term to reposition, as opposed to turning them into logistics centers or ghost kitchens or other things we talked about?
So Kyle, look, I'm a research geek by background for 35 years before going into banking. So I don't look at, my opinion meaning a lot. I look at anecdotal evidence and I follow the capital. Now, that doesn't mean capital and herd mentality is always right, but there's quite clearly office buildings and the way people work together in the past is going to change in the kind of the new normal of office working and retail. And to meet that challenge, these assets need to be repositioned. So asset managers, the big asset managers of the world, the big developers, the CBREs, the JLLs, et cetera, that represent them, are all pushing for repositioning of these assets, obviously. And also locals, towns, and cities don't want to see boarded up buildings. So you need to reposition those assets. And the best way to do so is to take old retail buildings, et cetera, old office buildings, or even newer office buildings, and retrofit them for the new norm, which basically means office buildings will have social distancing in place. There'll be a higher cost in terms of keeping things cleaner. But you can reposition a retailer to be a BTR or build to rent type of scheme. You could reposition a condo building that was going to be built in San Francisco for condos, and now seeing the fall in condo prices, whereas rents are pretty held up, reposition some of that condo towards a rental type of building, which is going to be harder to get loans in the post-COVID world, at least for the near future. So you can't look out for the next 6 to 12 months and basically say, yeah, nobody's going to go back to co-working. I need to look at capital the way pension funds, family offices, and asset managers look at it from at least a 5, 10, 15-year time frame. And over that time frame, I think the new normal is the repositioning of these assets for something that fits within our culture, fits in the new normal. And that's basically where the capital is focused on now, looking towards the future.
And even positioning to smaller cities as well, right? So looking at kind of tier 2, tier 3 cities and
Well, that's
opening
been happening.
these types of opportunities.
That's happening well before COVID. Tax rates in California just going skyrocketing. People moving to Austin,
Yeah.
people moving downtown in New York City, and now that's the more expensive than Fifth Avenue or Park Avenue. I mean, that's been going on trend for a long time. So the trend also of moving out of large cities into suburbia, more and more people are talking about that. But the numbers aren't really showing that, and that's a sustainable type of situation. The job markets, the jobs are still going to be surrounding the large cities. So while the suburbs might be a little more attractive to some, the large cities will still attract people and in large scale, again, over time.
Good point, Ron.
Yeah. I think the trends, what Peter is talking about, are very interesting, and we track something a bit different. I think the last 10 to 15 years, we saw a trend that was to densify, both in office and in residential. And by that, I mean, if we talk about co-working, it's basically taking the same space and just put more people in it, utilizing open space layout. We definitely think that trend is reversing now, and you're going to see more. Your team members will ask for more closed offices, private offices. You'll need bigger space to house the same amount of people. In the residential, the trend in New York City and other cities were, small units, almost micro units. Main business plan here was to take a 2-bedroom apartment, turn it to 3-bedroom, and then share 1 bath or 2 bath. I think we're already seeing a significant push from tenants saying, I don't want that. I want to be able to have, I'm okay having a roommate, but I need my own bathroom. I'm not going to share a bathroom with another person. In the office space, they're going to say, we want less open space. We want more closed offices. So I think that's the trend we're going to see in the next couple of years. Moving to the suburbs, that's definitely a short-term trend, but long-term, it's just not sustainable. You cannot house the human population in suburbs. It's just, we don't have enough land to do it unless everybody moves out to Montana and Wyoming, which is not happening right now. So I think
not a bad idea.
It's a great idea, but
a lot of innovation happening. A lot happening in those cities. I mean, this is something I will interrupt for, is that people write off a lot of those cities, especially here in the States, and look at Europe, look at Asia. A lot of those tier 2, tier 3 cities actually have a lot more going on than people give them credit for. I mean, Wyoming is doing a lot in terms of financial services. Look at Salt Lake City in Utah. Salt Lake City has an enormous amount of capital and incredible successful businesses from the tech sector that people, again, just write off as not a tier 1, New York Bay or Los Angeles City. You look at China and the Greater Bay Area and the 11 cities that they have there. Of those 11 cities, 7, if not 6 of them are thriving when it comes to innovation. You look at Europe, and again, you go down to those tier 2, tier 3 cities, there's more economic stimulus, there's more opportunity zones, there's more schemes to drive these types of things. So it's very possible.
But there's still cities, and that was the point I was trying to make. The notion that everybody will live in a private home with a yard and maybe a pool, which a lot of people in New York are now talking about, that's what they want. That's not sustainable. But I completely agree with you. Second tier cities, Denver, Austin, they're great places to live. But people will still live in dense urban locations. So it's not going to solve Corona, right? We're still going to have cities.
Right. No, I think that's a good point. Brian, I see you shaking your head as well there. Anything else to add?
No, again, just piggybacking on that point. I mean, this is the Rocky Mountains behind me, Breckenridge, Colorado, and I think Denver, of course, is a very interesting for food. It's Denver, Boulder area. The Rocky Mountains have become a real food innovation hotspot on the planet and for the United States. But anecdotally, again, from friends, I'm seeing people move out of some of these mountain resort towns where it's maybe too expensive or their restaurant business has fallen apart. They're moving back, whether it's to Montana or Indiana, they're moving back to maybe their hometown. So it's a smaller city or a village. not suburbs. It's sort of an area they have a connection to. And so that's a migration that I think is going to play out. I don't know what that means for resorts like Hawaii or, ski towns. Of course, ski areas were closed abruptly during last year's ski season or at the tail end. So if you look at Vail Resorts and what they're doing right now, they're planning for fall and winter. They're actively selling ski passes, and I don't know what occupancy is like in the mountain town hotels, but I think there's both a demographic shift of people moving out of those areas who can't afford to live there anymore, and as you said, maybe city people who say, I'm not going to live in the city anymore, I'm going to move to a mountain town. That is happening, but of course, as Rand said, you can't have 8 million New Yorkers move to Breckenridge, Colorado.
Not all at once, at least, but agreed all around. And guys, looking at the opportunities here. So whether I'm an investor looking to buy in, or I'm an entrepreneur looking to build in this space, where are you seeing opportunities that both sides can take advantage of? I mean, Peter, you've put $3.5 billion, if I'm correct on that, to work. Brian, I know you've made some investments and we've talked about this. Ron, you've made some as well. Where are the opportunities for investors to start jumping in and then founders to start building in? Because there's opportunity everywhere, but where are you seeing kind of the big places that people can start playing in this industry? And Peter, let's start with you. You've got big money at work here. Where are you looking at as advice to those?
Innovative. So we're currently looking at two interesting companies. One that tried to have a social angle to it, and they basically look to transform cities around the globe. They started in Latin America. They're moving to the States. They'll move out to Europe and other places. They're looking to transform different parts of cities that nobody would go to. Then over time, they become the cool new places to go. So over a 7 to 10 year time frame, they invest in these places that would look like drug dens or crack dens or something. But over time, you invest a little there. You start seeing people move there. You open up a cool coffee shop. You eventually attract a school to open there. And then all of a sudden a community starts. So investing in long-term communities in urban areas, I think is a interesting opportunity. Investing in experiential type of hotel opportunities, hospitality, although social distancing is going to be the norm, but basically finding those communities kind of like hostels, but at a much higher end that the millennials and the next millennial generations will be able to afford. Nice places to stay, clean places, safe places that take social distancing into an account will also be a future trend, and we're looking to take advantage of that. And there's some hotel operators we're looking at there. On the other end of the hospitality, as I mentioned before, high-end operators like the Six Senses of the world will benefit more and more from those people that can afford it, because social distancing is the norm for those and will likely continue to be so. I mentioned repositioning of assets, whether those are retailers or older office buildings. A lot of the panelists talked about more space, closed office environments. I don't necessarily agree with the closed office environment, but necessarily more space between workers, more people working from home. So that basically goes to my build to rent scheme, where you reposition assets to have more rentals that it can be repositioned, very flexible. You're going to see a lot more assets going into those areas, and that's where our capital is going.
So question on that, Peter. Brian and I talked about this on a previous episode here at VCTV, but you mentioned repositioning of assets. So in terms of that repositioning, are you seeing anything that's headed towards potential small hyperlocal logistics centers or small warehouses, if you will, inventory holds, and or ghost kitchens, like open kitchens or ghost kitchens where multiple restaurants can share that same type of asset? Are you seeing anything like that?
For smaller investments, yes, the kind of the ghost kitchens and stuff, I think will be a bigger trend going forward. Here in London, because of technology, the Deliveroos, Uber Eats, that type of stuff has just skyrocketed and will continue to do so. at least in the near term. Where I'm seeing more capital being invested is in the larger data centers, logistics, industrial spaces. That has not changed in the post-COVID world. And so that's how I'd answer that question.
That's great.
One other thing, though, in terms of,
Yeah.
Brian spoke about the whole move to more organic foods, that type of area of industry. We're seeing more and more capital being deployed there from asset managers. It's all part of the kind of ESG compliant environment, socially aware, corporate governance. So we're going to see more trends towards that and away from those companies that are viewed as poisoning the climate, poisoning environments, poisoning the food. We see more and more of that trend continuing. And although it's more venture capital like, it'll become more of an important asset class for some of the bigger mutual funds and others it already has going forward.
Data centers, it's an interesting toss out. It's actually something that hasn't been mentioned. Like I said, logistics, hyper-local logistics or inventory holds we've been talking about, but data centers we haven't, right? We're talking about the opening up the future of connectivity and 5G coming into play and all of these sensors, which is a little bit of my background from IoT, but no one has talked about the repositioning of some of our assets towards more data centers and that we're going to need these things.
It's absolutely huge, particularly if you go up, again, I'm in Western Europe, so go up to the Scandi countries where it's really cold most of the year. You don't need to have the same sort of large energy and air conditioning units. So repositioning old warehouses, buying green land, green fields, and having it for larger data centers. We're seeing some of the largest technology companies in the world making large investments in North America, Western Europe, in these more rural areas where the price per square foot is more attractive.
This is just a great opportunity that again has just not been touched. So thank you for mentioning that. Brian, same question to you. I mean, where are you seeing the opportunities? And I'm just going to throw this to you as well. What about agriculture? What about vertical farming or some of the repositioning of these assets? Could they be used in an agricultural sense, to Brian or to Peter's point around, organic food as well?
Yeah, I think, in fact, that is happening. Food being deemed essential has allowed it to push in different directions. I know of a few indoor farms who have gotten very inexpensive leases in New York City right now for large open, what were formerly restaurant club spaces, and they've repurposed them as indoor mushroom operations. So, this is actually a mushroom growing startup, Smallhold, which we are an investor in. This is a short-term solution for them. They're already building their main macro farm elsewhere in Brooklyn, and they're planning other sites in the United States. But it is true, I think some spaces can lend themselves to high-value indoor production. That technology needs to continue to evolve. It's mostly leafy greens. If you look in Asia, or New York or the United States. What we're sort of the investments that I'm looking at immediately in my own pipeline for the funds I work with, farm-based software is an area that we're looking deeply into and may make a significant investment in. Obviously, any sort of digital transformation for farms and any food businesses is required at this point. So there's going to be a big push to get the remaining analog sort of mom and pop businesses, get them a technology solution that works. And then, yes, all of our CPG and grocery investments are 100% clean label, often organic. Regenerative ag is a term that's getting a lot of attention now with its climate mitigation connection. But yeah, we really don't see any sort of junk food investments as long for this world. It's really all about keeping health at in every way in mind.
Ren, how about yourself? Where are you seeing the areas of opportunity?
So I'm very bullish on New York long term, recognizing that the short to medium term is going to be very challenging. So right now we're extremely focused and very active on lending and providing flexible financing solutions to owners, developers in New York City. A lot of condo inventory loans that we're underwriting right now in our fund. It's a unique time frame where you can deploy capital and get a decent return at a fairly low risk, although you have to watch out because underwriting values right now is very, very difficult. What is the value of a multifamily or a condo building or a condo unit in New York City right now? That's our biggest challenge. But if you implement a significant margin of safety, and we try to be at 60% loan to value and under, I think it's a very interesting time, and we're seeing a lot of deal flow right now for our debt fund in New York City.
And looking at call it the next year ahead, maybe 18 months for this industry in particular. What does the fundraising or investment process look like, and how has things changed? And Brian, I want to start with you because you're investing in companies within this space, but as all three of you have mentioned, a lot has changed, a lot has been disrupted, and it's probably going to take some time for recovery. So when you're looking at investing in companies, or companies are coming to you for fundraising around hospitality and travel, what has changed, and what advice are you providing to them to really get ready to be successful in their fundraising efforts?
I'll say quickly, since we're not really looking at any hospitality or travel, for all the investments we're looking at, it's interesting. There was definitely a speed bump in February or March, to say the least, and we saw a lot less deal flow. Now we're seeing a lot of deal flow where the rounds are oversubscribed. There's so much investor interest. So I think the pendulum has swung in the opposite direction. All of the deals that we're looking at are quote unquote oversubscribed. Maybe there's a premium on access for the really good deals, perhaps. But of course, one of the reasons deals are oversubscribed is because valuation has come down. It's become very clear what businesses can survive crises like this and which will be positioned to thrive. So, creative financing, in the sense that rounds that maybe we thought we missed have opened back up. People who maybe were not going to fundraise for a couple of years are being opportunistic and thinking now is a good time. So it's still quite strange, and there's a lot of different, diversity of deals that are floating around. But I feel like deal flow has come back to almost full steam, at least in the sectors that we're in.
Wow, and not even full steam. It sounds like well beyond full steam with the amount of deals that you guys are seeing. Ron, to you, you're doing debt financing, as you mentioned just moments ago. How are you seeing this fundraising process change? If you're looking at whether it's real estate assets, it's companies building in this space, how have things changed, and what advice are you giving to those looking ahead for the year?
I got to tell you, it's very interesting. We've raised our fund basically virtually. I did not get on a plane or in a car to do a single meeting. Granted, I would say 90% of our investors are institutions or family offices that have invested with us in the past on specific deals. So we've had, common ground. I'm definitely seeing a lot of liquidity out there in institutions, in family offices, and ultra high net worth. There's a lot of liquidity. So it's very different than the 2008 financial crisis, where, there was significant illiquidity both in financial institutions and with private investors. Now we're seeing a lot of liquidity. So I'm seeing companies, and I think you saw the recent IPOs that occurred here in New York. There was a big IPO 2 days ago. Lemonade, an insurance company, originally Israeli team, then value has doubled over more than doubled overnight. So, and there have been a couple other IPOs like Vroom. So there's active financial markets for the right companies, and there's liquidity out there, so people can fundraise, may it be for a fund or an IPO or a specific, a venture. So and if not, so you have more meetings. I'm seeing a lot of family offices that I was never able to connect before because travel restricted. Just they're in London or they're in UK, and usually you would expect the face-to-face meeting, but now the new norm is, meeting on Zoom is completely fine. So you actually meet more people this way and able to pitch your idea to a much wider crowd than you used to.
Right. More networking in a social distant world suddenly. Zoom's bringing us closer together, even though it feels very far apart. Peter, to you, is same question. I mean, what type of advice do you have, or what are you seeing as the fundraising process has changed, working as a family office and with other investors as well?
So let me tell you about the pre-COVID world and the post-COVID world. Because we're all about relationships and long-term relationships and multi-generational capital, it's all about finding the right partner to entrust with our multi-generational capital. They have to be good custodians of our long-term wealth. So based on that, in the pre-COVID world, I would get excited. I'd meet a developer, might go to a local pub, have a drink, have a nice lunch, Milos or something like that, either in New York or the one in London, and say, I really like this. Let's get engaged on a particular deal. Now, in the post-COVID world, we're spending an extraordinary amount of time in what I call the pre-engagement, even pre-dating scenario, put it in terms like that, where we're looking at depth in the at the developers, their ability to execute, their historical track record, their teams under their belt, the supply chain, if it's construction companies, how those construction companies positioned, what architects they're using. Then we're looking at financial models. We expect them to provide really detailed financial models. We look at the costs, the revenues. We look at IRR numbers to make sure that the projects are sufficiently profitable enough to take on a certain quantum of debt, and then that there would be money left over for everyone to share. So a lot of getting engaged on any particular mandate. We're spending a lot of time there. We haven't necessarily changed our pricing, funny enough, in the post-COVID world. We are pretty much the same, around the same, maybe a little more expensive on the debt side. On debt for construction financing, we're somewhere between 5 and 9%, could be a little lower, not necessarily higher on senior debt. On equity, we tended to, prior to COVID, look at low to mid-teens type of levered IRRs. Now we're in the high teens to low 20s minimum, or we won't even touch an equity investment because we want to make sure those projects are going to be profitable enough. And that's where we're kind of looking at stuff. So number one, good developers, good execution capabilities, great management teams. And by the way, if they're ESG compliant, I know it's the new sexy term, but my view is anybody that's been a good credit analyst in their lifetime has been ESG compliant in looking activities. Means just basically good management teams, good governance, good social responsibility, and that includes on the environment. So good credit analyst would have had management teams checking that boxes a long time ago. Now it's even more important, particularly for a family office.
For our audience that may not know what that is, what does ESG stand for?
ESG is basically in environment, social, governance. So basically making sure you're environmentally compliant, you're adhering to proper social protocols, social basically what's good for societies should be good for investments. And then obviously corporate governance. You have to have great management teams that basically can execute on their plan, and they hold up a certain amount of character integrity.
Wonderful. And gentlemen, I thank you so much for your time today. We're at that top of the hour. I want to give time for everyone to get closing thoughts in on where they see the future of this industry going, and what business decisions you're making here in the coming 12 months. And then we'll come back and get a quick update on where everyone can find you. So Ran, let's start with you. What are your closing thoughts on where everything are and where everything's going in the next year or two to come?
I think it's going to take us 2 years to see true normality back. Obviously, that's my personal opinion. It's not based on data, as Peter likes to make decisions. But I think we're 2 years out before seeing back to normal. And I think we're going to see a lot of hurt, unfortunately, in specific asset classes, but probably tremendous, unprecedented opportunities as well. My main concerns are obviously the political environment, the elections coming up, and this unprecedented economical experiment we're living in, where all the major banks are just printing money, and that is my personal biggest concern. If we're not gonna permanently damage our financial markets by or have to pay for many long years we're living, are probably our kids and grandkids, big issues to deal with later on. But back to normality probably 2 years from now.
And where can everyone find you online if they want to connect further?
So best on we have our website at northwind-group.com, and always shooting an email or sending me on my mobile is probably the best way, and we can post it later on if you need to.
Wonderful. Peter, same to you. Where can your closing thoughts, and then we'll come back to where everyone can find you.
Great. So Kyle, back in late April, I wrote a piece called The Great Social and Economic Depression of 2020. And I highlighted at the beginning the terrible economic shock that we're going to experience in not just the US, but the global economy, greatest than we've seen since the Great Depression, if not greater. And those type of numbers will continue to come out, particularly as we see the second quarter. It won't be a V-shaped recovery, as many pundits talk about. It'll likely be, we're lucky to see if it's an L-shaped recovery over the next several years. But on the social side, the positives that will come out of all the terrible tragedies that we're seeing across the globe in the US, not just on unemployment trends and people trying to find jobs, but also the societal problems that we're seeing in terms of riots and looting. I think this pandemic has led to more compassion, more empathy, possibly greater respect. And I think hopefully that compassion, that empathy will lead to, or will have to lead to the haves and have-nots trying to come together in this world to try to figure out a better way forward for the larger society together. And asset managers and others are trying to do their share, as I mentioned, on the ESG compliant terms. Again, environmentally friendly, social responsibility, corporate governance. I think those trends are going to continue to be very, very important as we go forward. And I'm hoping that although a banker, we can be a compassionate bankers in trying to disintermediate the flow of capital from the haves to the have-nots. I think, as I mentioned, it'll be an L-shaped recovery. We're in for a lot more pain over the next 18 to 24 months, but we will get through this pandemic as we've gone through crisis after crisis after crisis before, and the patient and long-term capital will likely benefit from that. But I do think many measures are both on the debt and equity side are extremely overvalued, and I think we'll see quite a significant correction, particularly as we start to see these bad numbers coming out, even though they're hindsight numbers over the next couple of quarters.
And I would love to read the article and also share it with our audience. So if you can afterwards, just send it over and we'll post it as we do the post recap here. And where can everyone find you online?
So on I guess online, I please I find me on peter.plout@weimerfinancial.com. That's WIMMER financial.com. Also, my number is +44 7432 083790. I'm on Facebook, I'm on Instagram, I'm on LinkedIn under my name. Be happy to share my thoughts, insights, and more importantly, learn from everybody at large. Because to me, it's all about having a voracious appetite for learning and taking anecdotes and using those anecdotes in life.
Absolutely. If you cannot find Peter, by the way, online, he just gave you literally everything. If you can't find him, we've got a different conversation.
And by the way, I have 6 children, 3 boys and 3 girls. They're graduating. 2 of the boys are graduating university. Well, just graduated. They can't find jobs. So I'm feeling the pain just like everybody else in this situation. So, and
there you go. And if you're looking for talent, ping Peter. He might have a person or 2 for you. Brian, closing thoughts as well. And then where can everyone find you?
All I will add, this has been a great conversation. It's been a pleasure chatting with everyone. The sort of macro shifts happening in my perspective is hospitality, food hospitality has shrunk and will stay shrunk for a while, but we still have to eat. So that's all pushing towards grocery, towards the homes. And, conceptually, it seems like for the short term, we'll be making the fancy food at home where people are getting into baking and, making their own kombucha and that sort of thing, and preparing these lovely meals because everyone's at home and has maybe a little bit more time. But that restaurants in some ways will be simplified. It'll be much more towards the sandwich joint, the pizza joint, the place that does a different burger every week. So Folks can find me on LinkedIn. Is probably the simplest way, and I look forward to staying in touch as well.
Wonderful. Gentlemen, again, thank you all for your time today. Thank you to our audience for tuning in. Hopefully you got a very good sense of where everything is currently with the state of hospitality and travel, along with the big opportunities in this area, as mentioned throughout today's show, and how to be prepared to take advantage of it, and also maybe make some adjustments to your business or your business model and investment thesis as well. With that being said, a shout out to Elena and to the entire LA Token team for making VCTV possible. I'm Kyle Ellicott, your host. You can find all of us online. I'll be back here tomorrow.